All right. Good morning. Happy Monday. And everybody listening today, you've got the pleasure, as always, Nash Paradise and Matt Gouget, and why you might want to listen to us, or why what we say might be relevant. A few decades of mortgage experience between the two of us. And I think most importantly, still actively involved in originating mortgages, talking to real estate agents, talking to mortgage clients. And so we might get into the nitty gritty every once in a while, and Nash will nerd out on economic data. But really, more than anything, as somebody who's working with consumers all day, every day, to help them understand what to some might be, a complex mortgage market or real estate market. That's our hope. Sprinkle in a few dad jokes, sprinkle in some at times varying opinions. Nash is out in Texas. He might be seeing things in his market that I am not seeing in California, and vice versa. At times, we might have a slightly different take on how we might advise, but we're bringing it here to you live. You've got the opportunity to fire away any questions, comments, concerns you have. We'll get into a bunch of different stuff. Just happens to be, best rates that we've seen since December 18th. We'll tell you exactly what that means. And we'll get into some other stuff. What's up, Kevin Hawthorne from Florida? But first and foremost, what's up, Mr. Nash Paradise?
Hey, Gucci, when a joke becomes a dad joke?
When
the punchline is apparent. Sorry, couldn't help myself.
Yep, good stuff, man. How was your weekend? How you been?
It was good. I did a whole lot of nothing, watched some bad movies, hung out, stared at these market indexes, and just poured into. No, I actually didn't do anything with regards to the real estate market. Just hung out with the family, did kid stuff. The weather's getting better here. We had a bunch of 11 and 12 degree days last week here in North Texas, which was kind of ridiculous, but back up in the 60s and 70s, and having a good time with things here. So much more comfortable. I know that you don't get those wild weather swings in Sacramento, but they actually impact our real estate market here. When it's 15 degrees outside, people don't like to go see homes. So I'm definitely excited about spring weather and the spring market coming back here.
Yeah, for sure. I also did a lot of family stuff. Shout out to my son, Ethan, turned 12 yesterday. You just seem to me, Nash, like somebody who would really enjoy a good escape room. We did an escape room yesterday where we had to break out of a prison cell. You seem like the analytical, solve stuff type. Are you an escape room guy?
You couldn't be more wrong. I hate the concept. I hate the idea of escape rooms. I am way too competitive, and I will bully everyone to lead that. And it's going to be my ideas, my way, or the highway. That's why I'm not allowed in trivia nights anymore. The thought gives me anxiety. I will not have fun. I'm not going to be sitting back while my 10-year-old sits there and tries to solve something when I'm like, no, here's the answer. Here's what we can do. I may be exaggerating slightly because my kids really want to do one, and I will at some point. But yeah, I have a feeling my competitive nature is maybe not a good fit. I have a hard time keeping things chill.
Yeah, I had 7 12-year-olds, and about 1.5 at any given time would be listening. I was trying to solve the dang thing. I'm trying to put the spoons in order so that they spell the code for the next lockbox. We escaped. We did it in about 51 minutes. It was good times. But let's jump into mortgage and real estate. As always, I'm sure you can give us what's on the calendar this week.
Yep.
I think we've got a CPI number coming this week, if I'm not mistaken.
Well, let's go last week first. Since you weren't here, I had to do a wham bam quickie and just go through exactly what we were seeing on a shortened President's Day week. There wasn't a whole lot of neat stuff on the calendar. The only starred item was the S&P Global Services PMI. And I'm going to take a bet that 99% of people who are going to hear this, or even that are in our industry, don't know what S&P Global Services PMI is. So I'll give you a really quick rundown here. It's your Purchasing Managers Index. PMI is a corporate indicator designed to provide the overall view for activity in the manufacturing sector and acts as a leading indicator for the whole economy. Okay, cool. What does that actually mean? Well, anything higher than 50 means that the economy is growing. All right. Anything below 50 means it is shrinking. And this is in the manufacturing sector. What's interesting is, the previous result, 52.9, means we're growing slightly. The anticipated result, the projection for, last week was 53. We missed bad, 49.7. So instead of growing a little bit more than the previous month, and these are adjusted seasonally, so it's a pretty good index to watch, we fell under 50. So manufacturing, it was dropping. We're slowing down a little bit on there. And so we actually saw a nice bump in interest rates late last week. And so, like you said, we've got the best pricing we've had all year, the best rates we've seen since the middle of December. That's your why, is because we missed on S&P Global Services, and that started a little bit of a trend. Now, what are we seeing this week here? What's neat coming is core PCE on Friday. It's going to be another week where Friday is the big day. We do have jobless claims coming Thursday, which can move the needle. The last couple times we've had claims and continued claims, they've been pretty flat. And the analysis and projections on here, we're not expecting anything to really move the needle. It could, if it misses big, it's going to be a big miss. But yeah, core PCE month over month for January, we are expecting that month-to-month inflation figure to grow to 0.3% on a month-to-month basis, which is a pretty small amount of growth. I actually, previously we were at 0.2%. We could miss on this. We could miss low. And if we do miss low, that could be good for interest rates.
Yeah, and I think what I had heard and I had followed it in the past was that year-over-year number, since we're coming off such high numbers for the 2024 January number, even if that comes in as expected and, inflation, looking at it year over year, it's going to be a positive for mortgage rates because, it's going to be almost impossible to have it not see a downtrend because of how high it was last year.
Yeah. And what's interesting is, PCE, which is personal consumption expenditures, measures the purchases of goods and services by households. This is a really good leading indicator, but for whatever reason, some markets seem to care about it more. But like CPI is where we're all putting our money for one reason or another. So like the year over year, it's projected to go down to 2.6% from a 2.8 last month. We'll see. There's room for us to miss on the month over month, which will be a little bit more severe impact to the markets. The year over year, if it misses high because it is projecting downward there, it could flatline and see some balance there. All that to say, I wouldn't wait to lock something on Friday anticipating it to go down. I think the PMI numbers from last week were really interesting, but that manufacturing index is going to take a lot longer before it starts to record in other indexes, especially in our consumption. So all that to say, it's a pretty flat week until we get to Friday. If you like it, lock it. But, we're going to be watching well, and we'll talk about it next Monday, what ended up happening that week. And could we be starting a trend right now? We've been improving, week over week. And in fact, it's probably a good time to get to the numbers and see where have interest rates been going. I'll look at that. Here's our chart coming up right in front of us. So when I talked about this last week, and when you and I talked about this a week before, we had that blip where we dropped under 7% and shot back up. But what are we seeing here now?
Oh, well below 7%, which, for some people is not enough. But like you stated earlier, the lowest levels we've seen since mid-December. Whatever that is, it's probably like 6.85, somewhere between 6.85 and 6.9. If you haven't followed this in the past, this is 30-year fixed rate primary residence. The average across the U.S., generally speaking, for most credit scores, you might pay a little bit upfront for this, but it gives you an idea of generally speaking where rates are. We saw them bottom out last year, get almost to 6%, and then take quite a sharp increase up, bounce above 7%, and that will stall buyer demand. That will stall activity, as we've all seen. But it'll be interesting to see, because so much stuff plays into this, and I try to not get too overwhelmed or overwhelm consumers with different numbers. But the 10-year Treasury has come down, mortgage interest rates have come down, and really every incremental step down in mortgage interest rates just opens up the door for swaths of buyers that at 7% it didn't make sense, but maybe at 6.75 it does, or at 6.75 it doesn't, 6.5. Now the payment is something that we can feel comfortable with. We're going to go buy something in North Texas for $400,000 or whatever the numbers are for each individual.
So I'm going to quote you on that. Matt Gouget says that a 6.89% is well below 7%.
Well below what I mean. If it was treading around 6.97 or 6.98, that's a smidgen, but below
6.89. But as I joke, 6.89 does make a difference in consumer confidence. When that number starts with a 6, people are going to be a little bit more interested. And like you said, there are costs associated with this. It does require high credit score. Sometimes it requires larger down payment. But when the prevailing overnight average interest rate nationally is below 7%, that sounds better than it being over 7%. And as we get into the spring market, we are heading in a direction that is conducive for more activity, which is good for everyone and everything. Maybe not if you're hoping prices keep tanking, because home prices are going to be propped up by demand, and demand is going to be propped up by affordability. So my big question here is, are we getting to a trend? Looking at the data, we've had enough ups and downs here. We've seen things come down to this point and then shoot back up. So, the jury's still out, but this is the cheapest that we've been since mid-December. So fingers crossed that this is, trend setting downward, and, we'll need a lot more data before we feel good about that. And even if we do feel good about trending this direction, look at what happened from May of 24 to September of 24. You got lots of spikes, lots of peaks, lots of valleys, lots of movement. And then boom, it's gone. We lost where we were going. When a lot of people were thinking, hey, maybe we'll get into the 5s by the end of the year. Nope. Other direction. We got into the 7s by the end of the year. So all that to say, if you like it, if it makes sense for you right then, don't try to be the smartest person in the room when it comes to timing out the market. You never buy stock at its cheapest. You never sell at its highest. If things make sense, then we're going to take action. But let's move forward and talk a little bit about what's going on at the Fed. And where we think things are going. My last analysis last week, Matt, just to fill you in, is I'm anticipating 1 to 2 moves this year. And I think the first one's not going to come until June or July. I would prefer July just for a smoother transition, but let's see how the plots have changed since the last time we spoke. Right now for March, is that March? Yeah, that's March. No change. And that's no change. Like, we're not dropping in March. I think we can all safely assume that. So let's move into May and give me your thoughts on that while I get some energy drink going in my system.
There you go. Get some of that going. So in May, it looks like about a 1 in 4 shot is what's projected for a 25 basis point cut. Still overwhelmingly, favoring no cuts for either the March or the May meeting. And as we go through these two, just a reminder to people, like, how you look at this. When this is a projection for May, they're saying between the March and May meeting, there's a 72% shot that there's no move between either one. And that's what the far right, bar is, the range between 4.25 and 450. And then in the middle, 26.9% is we're going to get one cut. Doesn't say whether it's March, doesn't say whether it's May, but between one of those two meetings. And so as we get farther along, and there's, the probability that we're down 25 basis points on, for whatever reason they do this range, right? It's 400 to 4 1/4 versus just saying 4 1/8, which I've seen more people, Nash, nowadays are just calling that like 4 1/8 just to make it easier for brains to kind of comprehend versus a range. But either way, this isn't necessarily like on this meeting, this is what's going to happen. It's like on or before this meeting date. This is
where are we by this time? And I think the other decent takeaway here, and kind of what I focus on, is the trending month over month and week over week. And on this chart specifically, looking at 1 week ago's forecast, we have gone up 10 basis points towards the one drop. So obviously one drop is still a 25%, 26% chance by this point, but that has improved almost 10 bips. So we are trending in a direction where the likelihood of that drop becomes more significant. And that's really the good takeaway here. Let's check June, because last time we looked, June, 1 week ago, it was overwhelmingly in well, maybe not overwhelming, but it was a strong push towards no drop by June. But look at what we got right here. This is now flipped to where by the June meeting, 48.8% is a strong recommendation that we have one drop. And in fact, if you add the 2 and 3 drop data into here, we're talking, 63 versus 37. That's a pretty good 2-for-1 that we would see the first drop by June. And I think most people just want that first drop to come in June because it will mean we're more likely seeing 2 drops this year, which people want to see it early. And, like I said before, I think the Fed should be patient and wait and be slow on this stuff, but they weren't last time. So, I understand why people think we'd see a drop in June.
Yeah. Quick side note. And I was going to ask this. You showed the chart of the 30-year, average rate. And I think it was between May and September, kind of a steady tick down to whatever it bottomed out at, call it 6.1%. I know like how much that kind of revs up purchasing, application demand, and everything. What are the chances that we see something similar this year in your eyes, Nash, based on stuff you're seeing?
Well, I think that's what most people are anticipating. And the problem is, are they anticipating it because they really want it to happen, because they have a vested interest in it, or because the data suggests that happening? Who knows? I mean, the Fed right here and what we're talking about, what we're seeing is suggesting by the time that we get into June that we would need another 1/4 point drop by the Fed. And if we are trending in that direction smoothly and based on the changes in data week over week, month over month, it would suggest a smooth improvement. And that's a lot of what we saw, at this point last year was, slow and steady on that. I think we've already absorbed and dealt with the anticipation of going from, 5 rate drops in 2025 to 2. The market has already responded to that. 10-year treasury bond shot back up, and now we're just seeing some slow movement. Now, anything could jump in and change that pretty radically. But if I'm a betting man, and I am also projecting these smoother rate drops. Now, like you said, as rates go down, demand shoots up, and that's going to stall any kind of major market movement, because as purchasing improves and people are buying and selling, you've got more money going into the economy. You've got more things being spent on construction, housing, and housing can move the economy. Housing is that big. So if we start to see rates drop down, it's going to be its own undoing to a point that, we see all these numbers start to come up and that spending increase. It's going to slow down any kind of, overall movement that helps drive rates lower.
Yeah, I mean, I think it bodes well for a relatively healthy housing market. The spring, most people know, is the time when the most transacting is done in real estate. To your point, 10 degrees isn't, fun shopping weather, but, when it's 65 and sunny and people are out viewing, also they're trying to time it where their kids are out of school and whatnot. I think it bodes well for some of these markets. I think there's markets in Texas have an increased inventory. Stuff isn't necessarily selling super fast. So if someone's been on the market for 45 or 60 days, rates start to trickle down, the sun comes out, there's more buyer activity. These houses, likely to move a little bit faster. And, for a lot of buyers that I'm currently in conversations with, they've got a bunch of different dynamics, selling one house, buying another, trying to time that, trying to do both at once, not trying to minimize the amount of stretch or whatever you want to call it when you leave a 3.25 and you strap yourself to a 7.5. As that gap narrows, it makes some of those scenarios more palpable for most people who, quite honestly, need to do it, right? Having, I've got a client.
Well, I'm going to pause you on that, Matt. Let's finish out July here, and then we'll get talking into the wins, because I want to bring your pretty face up in full screen here. And I don't want to, I know you're excited because we have some wins and some fears and some good takeaways and call to action for people who are watching this. But let's finish this last slide out so I can see you in all your glory here, because you're a little small and I love that pretty face. That's the moneymaker.
Let's do it.
Just to summarize what we're seeing in July here, this is, in line with what we're thinking. But look at the difference week over week in the no move in the 425 to 450 range, all the way down to 27%. So this is your, basically 3-to-1 that by the end of July, we've got one Fed rate cut. And I would agree with that. I like the idea of it happening here, but I'm usually wrong in that. I'm usually behind what the Fed actually does. So I think this is telling us by the end of July, highly likely, 73% chance we've already seen one rate cut, and it's probably happening in June. Do you have anything else to add to that before we move on to some fun stories?
No, I'm not going to put too much energy into worrying about when they'll do it, but I concur that,
it's my job.
By the end of July.
So who needs to care about this right now? Why is this stuff relevant? Because it's a pretty good change from the last week and the week before. Who needs to have this in upfront information? Because this is not public information yet. You're not seeing stories on Yahoo. It's not moving the market. So how can someone take this data and use it to form wins right now?
Yeah, I think, like I was talking about, the number of buyers that are in a position where current house isn't fulfilling their needs. I was starting to talk about a buyer who's got pregnant wife with twins. They've already got 3. So these are kids number 4 and 5, and they are in exactly 1,000 square feet of home in Sacramento. That is not cutting it. And so
it's like a $900,000 house in Sacramento, right?
750. Yeah. So
that makes me ill.
So a nice neighborhood. These are the types of buyers that, they need to upgrade. They need a larger house, and going from low interest rate to 7.25, hurts. Going to 6.75 or 6.75 hurts a little bit less. And so, I've just got dozens and dozens of scenarios where, as a math nerd, I'm saying, we're taking this much equity from this house, we're putting it down on that house. Here's what the monthly payment is. And so you might be going from $2,200 a month to $3,600 a month. You might be going from $2,200 a month to $4,000 a month. As people earn more, as they just are getting used to larger mortgage payments, the incremental drops in mortgage rates just help that. You talked about affordability being something that buyers are very cognizant of, might be the most important word for them as they make these moves. So if we get into the season in the year where more buyer activity is going on and there's more movement, and that correlates with rates trickling down, I think it just bodes well for more housing market activity. And really, quite honestly, better for buyers and sellers. For sellers, more action, and for buyers, affordability with interest rates looks a little bit better, and the move up isn't as uncomfortable as it was maybe mid-December when we were well above 7%.
100%. So I'll give my final point into John's question here in the chat. I am wearing Crocs, but they don't really look like Crocs. These are my new tennis shoe Crocs. I mean, they're pretty ridiculous. You know, if you're going to be rocking Crocs, you know, you got to have all the Crocs, not just the OG clogs. So yes, I am definitely crocking out today. But my final takeaway here is, fear-based, because fear moves people more than hope. So here's your balanced market. We don't have that right now. Interest rates are high. And, flexibility for sellers is low right now. Here's the way that the markets are going to behave. First, interest rates are going to fall, and you're going to get this real cool sweet spot. Interest rates fall first, but then prices come up. And it depends on the exact market, depends on the price point. Where are they going to go up faster? Where are they going to go up first? Low to moderate income, cheaper homes, condos, anything under $200,000 to $300,000. That's the first place, because as rates go down, affordability goes up. In the pocket of buyers, that affordability is the biggest factor. These are renters, first-time home buyers, move-up buyers. So who wins? It's the people that can get in as rates start to fall, but before pricing goes up. There's going to be a window. And when you miss that window, the problem is like sitting back, waiting longer. Rates are going to drop for a longer amount of time, especially over a wide range of time. We've already discussed at length that there is not enough new construction inventory to keep these prices down. It's resale. So if there's not enough homes out there, we're going to see a 2021 market, an early 2022 market where there's too much competition and people are having to overpay for things. Now, that's really not going to kick in and engage until rates get under 6%. But at certain price points, that could be you. If you're a low down payment FHA first-time home buyer, you need down payment assistance. You need to get $7,000 to $10,000 in seller concessions. There's going to be some point in this year, and it may be the spring, it may be late summer, it could be anywhere in the middle, where your advantage goes away, and you're competing with too many other people who can afford that same home. So if you're a real estate professional, mortgage professional, or just someone watching this, if that's you, it's time to be very diligent and be paying attention to when you can make a move on the market. It may not be the perfect time. Maybe you should have waited 6 weeks, but over a long enough amount of time, you're going to be a winner. You don't want to be a loser. It is better to win less than to lose, because if you miss completely and then you're having to overpay and having to compete with people you can't compete with because of your structure, your loan terms, or what you need, you may be waiting for a market that never comes.
Yeah, I agree 1,000%. Very well said. And I just want to double down so that people hear this. You want lower rates. You want a cheaper mortgage payment. You want a lower price on the house. You want seller concessions. You cannot have all those things. You've got to pick one or the other. As when rates were higher, you were getting more seller concession. Sellers were having to lower their price or give seller credit in order to move their house. As rates come down and affordability gets easier, especially like you said, Nash, entry-level price points, in your area, it might be 2 to 3, and in some, California areas might be 4 to 500,000. Those are the first areas impacted. Rates come down, demand gets injected. Now all of a sudden, sellers don't have to give anybody credits ever. And then there will be a time when they're listed, they've got 7 offers, it's $499 list price, someone's willing to pay $515. And so as a buyer, I think that's golden advice, Nash. Act first before everybody else does. By the time, this stuff becomes common knowledge and, we're mid-May or late June, neither of us knows the exact timing of it, but, rates are 6.375 and there's 8 to 10 offers on everything that's sub 500,000 in Sacramento. Like by then it might be a little bit too late to think about how do I ask for $10,000 in credit, or how do I, go out there and get something that fits under this price point that also works for my family. So good advice. And as always, the best way to go out and buy real estate is to first and foremost connect with great professionals. Great mortgage broker, great real estate agent. Make sure you're dialed in, pre-approved, ready to roll. You've had the conversations, you've seen the numbers. Then go out there and start, letting the professionals match make the house that fits your criteria.
100%.
All right, Cool, man. We'll reconvene next week. As always, I appreciate you, brother, and have yourself a phenomenal week.
You too, homie. Take care.
All right, later.